In this edition, we dive into a little more detail on your risk plan. Two chief risks that people want to protect against is the risk of losing income and the risk of losing assets. Now, the risk of losing income can be mitigated by life insurance, and some of the questions there to consider are, do you have your insurance cover within super or outside super? And also buy-sell funding. So if something happens to you and you're involved in a business, how do you transfer your ownership interest in the business to your perhaps previous business partners without paying too much tax? So life insurance can be a very useful way of protecting your family from the consequences of a loss of income through something like death or even temporary disablement. Loss of asset is another area where insurance can be useful, particularly general insurance. Most people would have car insurance and home contents insurance. That can help you protect against the risk of losing an asset through a flood, fire, theft. But also there are simpler ways, non-insurance ways, which is having a savings reserve. So some people self-insure either ad hoc or actually clearly say, well, I want to save 1% of the value of my asset every year and put that into a specified savings account rather than paying an insurer. And of course, diversification. Rather than owning one asset, you might own several assets in different areas. If you are into property and you might want to build a property portfolio, you probably wouldn't be as interested in buying 3 houses in the same street, but might have a house in Sydney and a house in Brisbane and a house in Melbourne to have exposure to the different economies. Another type of risk that you might want to protect yourself against, interest rate movements, and that in the middle of 2013 we've seen a lot of discussion about that in the newspapers, and that is something that's very top of mind, but they're always with us, whether they're going up or going down. Interest rates are always moving within a 3 to 5 year time frame. For that, the two key ways of protecting against the risk is known as hedging, which is actually buy insurance, so you can buy something at an agreed interest rate locked in, and then duration management, which is around making sure that if you buy a bond, you are quite clear on how long the bond is. In other words, how long before the person who has issued the bond has to repay it. The longer the duration, the more risk you'll lose value when interest rates change. And the final aspect of your risk plan that we typically help clients with in the financial planning process is market volatility. And two key ways of reducing that risk is through asset allocation, so investing in shares and listed property, perhaps direct property, cash, fixed interest, government bonds. So trying to spread it around based on what you're trying to achieve and how comfortable you are with the ups and downs of the volatility of the different asset classes. And the other way is portfolio protection for people with a bit more ability to or a bit more interest to understand. And there is possible to pay for portfolio protection with shares using options called puts or calls, which is ways of agreeing to sell a particular share at a given price. But effectively, there are ways of buying protection against market volatility. Thank you for watching.